The year is 1990, New York City. It's a humid summer day and you're strolling down Central Park in the middle of Manhattan. All of a sudden, a middle-aged man holding 2 McDonald's bags and a liter of Coca-Cola approaches you asking for money. Nothing too out of the ordinary for the city. You tell him you don't have any spare change and go about your day. A couple minutes later, and you're approached by another guy asking for money. He's a math professor from Long Island and says that he needs money for some science project. Undeterred, you tell him to get lost and eventually reach your destination. Billy's Hot Dog Cart. The best dogs in the city. The line is long, so you have time to reflect on your previous interactions. You see the 2 middle-aged guys haggling some other people for money, and you briefly feel a sense of pity. Those poor guys. Instead of just doing nothing, you decide that today is the day that you'll make an actual difference in the world. Instead of spending all 5 of your dollars on a premium hot dog, you allot $1 to give to each of the homeless dudes, and $3 for a regular dog. Seems like a good plan. You order your hot dog for $2.99, load it up with relish, and sit down on a park bench to eat it in 3 bites. That was the best investment I ever made. You get up, give the random guys $1 each, and go back to your apartment. On TV, you learn something stunning. That old guy with the McDonald's bag asking for money, yeah, that wasn't a homeless guy. That was the 10th richest person in the world and famed stock market investor Warren Buffett. And he was looking for investors. Taken aback, you quickly grab your last $100 and run all the way back to Central Park. Thankfully, you see the glory of a beige Cadillac sitting in the parking lot and run towards it. You pass the old math teacher still asking for money and think why anybody would give out money for nothing in return. This is America after all. It's all about capitalism, and even though you don't know much about the stock market, you know that this Buffett guy does. He graciously accepts your $100 investment with greasy McDonald's fried hands and tells you that you've made the best decision of your life. You walk home a happy man. You have a full stomach, you donated to somebody in need, and you obviously made the best financial decision of your life by investing in Warren Buffett's company. Yeah, wrong. What if I told you that during this scenario, you missed out on an opportunity to make potentially millions of dollars? Don't understand? Let's dive in. Today, on The Money Game, we're talking about the investor that was 500 times better than the famed Oracle of Omaha. And you might not even know his name. This wouldn't be surprising though. During the year that Warren Buffett bought Berkshire Hathaway, this unsurprising future investor was getting his PhD in mathematics at UC Berkeley. His name was Jim Simons, and he would go down to be one of, if not the best, hedge fund manager in all of stock market history. Unlike most famous investors, Simons didn't choose this destiny from an early age. For the first 40 years of his life, he was a renowned mathematician. He published scholarly papers, taught at Harvard University, and even discovered a new mathematical theory in physics. In 1964, he got a job as a code breaker for the National Security Agency and used his genius-level knowledge to help defend America during the Cold War. He was a well-respected scientist and received a national prize in geometry for his contributions to the field of mathematics. After spending the middle of his life in the academic world, Simons made a huge pivot in the late 70s. He founded a hedge fund called Renaissance Technologies. But instead of hiring a bunch of finance professionals, he gave jobs to physicists and mathematicians. This would be the key to Simon's success in the market. He approached his investing philosophy from a quantitative perspective. Instead of looking at business fundamentals like Buffett, Simons developed mathematical systems based on historical patterns. Simons was not in the game of investing, he was in the game of quantitative analysis. Duly dubbed the Quant King, Jim Simons and his team of scientists would continue to develop their trading strategies throughout the 1980s. When a proven track record was established, Renaissance Technologies founded the Medallion Fund, which would go on to be the best performing hedge fund for the next 30 years. So let's dive into the numbers and see how Simon's Medallion Fund stacks up to the general market, along with Buffett's Berkshire Hathaway. The period that I'll be using for this comparison is 1988 to 2022, a period of 34 years. For ease of comparison, we'll pretend that $1 was invested into each of these instruments in 1988 and held until 2022. With this in mind, a $1 investment in the S&P 500 in 1988 would be worth $15.54 in 2022. With a generally high correlation to the overall stock market, this investment is completely respectable. On average, it yielded an 8.4% average compound growth rate and strongly beat out inflation's average 2 to 3% rate of growth. If you invested consistently into the S&P 500 during this time period, you'd have a high chance of retiring comfortably come 2022. Overall, nothing is inherently wrong with this return. This investment only saw a net loss during 9 of the 34 years recorded, and it posted gains in the high 20% during multiple years. Let's crank things up a notch though. Let's look at Berkshire Hathaway. Warren Buffett's Berkshire Hathaway is generally regarded as one of the most successful businesses in the investing world. A business-savvy investor who began his journey at a young age and transformed a dying textile company into an international business conglomerate. What a headline. If you invested $1 into Berkshire Hathaway in 1988, you would have $158.86 in 2022. Now, don't let this seemingly insignificant sum of $150 fool you. This is an incredible gain. What if you had invested $10,000 in 1998? Well, you'd be a millionaire. It's that simple. Berkshire Hathaway experienced some of its most successful years leading up to the change of the millennium. It posted a return as high as 85% in 1989, and only had 6 total years which resulted in losses, all of them being attributed to market-wide corrections or recessions. During the years in consideration, Berkshire Hathaway's compound annual growth rate was a staggering 16.07%, double that of the S&P 500. This really puts into perspective the power of compound growth. Even though the growth rate was only double that of the previous investment, the fact that the investment was grown over a long period of time allowed for the ending result to be around 10 times greater. While this return is fantastic, what if I told you that it doesn't even compare to the Medallion Fund? Don't believe me? Let's look at the numbers. In 1988 and 1989, at the very start of its inception, the Medallion Fund recorded what would be its worst years over the next 30 years. A gain of 9% in 1988 and a loss of 3% in 1989. Now, a gain of 9% might sound decent, but it was far below our other comparisons. In 1988, Berkshire Hathaway returned an amazing 59% gain, while the S&P 500 returned a still above average gain of 12%. So, if you were an investor in 1990 on a humid summer day in New York City, the decision to continue investing in Buffett's Berkshire Hathaway would have been an easy one. It's been around since the 60s, it has a great track record, and this newfangled quantitative analysis doesn't really seem to be working for Jim Simons. The decision is easy, but like I said earlier, you'd be wrong. Very wrong. For the next 30 years, from 1990 to 2022, the Medallion Fund would do the impossible. All of those scientists and physicists, their work would pay off. Big time. During this time period, the Medallion Fund didn't have a single year of negative growth. Not 1 year. And this was during a time which included the dot-com crash, the Great Recession, and the COVID crash. In fact, on average, the Medallion Fund reported positive returns during 11 of the 12 months of every single year during this time period. Have you ever heard of such insane consistency in the stock market? I definitely haven't. The Medallion Fund was a bullet train and it couldn't be stopped. In addition to its unwavering consistency, the Medallion Fund produced the most extraordinary gains ever seen in the market. Its average compound annual growth rate was a mind-boggling 39.87%. Now, I'm not sure if you're used to dealing with numbers like this, but this rate is simply unbelievable. Like, truly, it is hard to believe it actually happened. To put this number in a simpler perspective, you can use the rule of 72 to find that this rate would double your money every 22 months. A general stock market index would usually take 9 years to generate the same return, 5 times slower. Before I reveal the Medallion Fund's ending return, considering our $1 investment, I want to talk about some of the stunning events that have happened in this fund throughout the years. First off, I just can't stop talking about the numbers. In 1990, when Berkshire Hathaway returned an abysmal negative 23% on the year, the Medallion Fund yielded investors a gain of 58%. In 1994, when the S&P 500 index experienced a 1.5% decline, the Medallion Fund made a gain of over 70%. The craziest part is that even when there were international broad market declines during the recessions of the 2000s, the Medallion Fund stayed afloat and experienced some of its biggest gains. During the dot-com crash of the early 2000s, the top technology companies in the stock market were crushed. From 2000 to 2002, the S&P 500 experienced an annual decline of 15% per year. Over $5 trillion was wiped out from the stock market in a relatively brief period of time. So, how did the Medallion Fund perform during this time? Well, it was a different experience to say the least. In the year 2000, the Medallion Fund posted its best return ever, a gain of 98%. In fact, while the S&P 500 experienced a net decline of 40% during this period, investors in the Medallion Fund yielded a 230% gain. 230%! It's insane! What about 2008 though? After all, that was the third worst year in stock market history. The S&P 500 lost 38% during that year, and losses extended up to 50% during the start of 2009. No investor could win. Not even the all-knowing Warren Buffett could prevent a loss. Shares of Berkshire Hathaway tumbled 32% going into 2009, so the Medallion Fund must have lost money, right? Wrong. Cue Jim Simons and his team of science geniuses. During 2008, during the worst period of the American economy since the Great Depression, when everyone lost money, the Medallion Fund had its second best year in history, at 82% gain, which is legitimately crazy. Even during the post-2008 recovery, the Medallion Fund's lowest year in the 2010s was a gain of 29%. Make that make sense. The fund also surged in 2020 during the COVID crash. It experienced a 76% yearly return. At this point, you're probably wondering to yourself how all of this is possible. How is it possible that the Medallion Fund had its best years during the darkest times of the American economy? Maybe they hedged their trades against the American people, or perhaps they were the ultimate bears in the market. While these theories might be exciting, none of them were true. Jim Simons and his team at Renaissance Technologies were not stereotypical investors. Half of the employees that worked at Renaissance Technologies had PhDs in scientific disciplines. They collected terabytes of market data, made algorithms, and used computers to execute trades at an extremely fast rate. They didn't have a stock portfolio like a normal investor, and they didn't dig into business fundamentals like Buffett did. They were high-volume, high-frequency traders. Surprisingly, even though you might think that the Medallion Fund always made money, it was actually only successful in generating a profit of 50.75% of its trades. The thing was, even though this win rate was only marginally better than neutral, the sheer volume of trades executed by the firm propelled its returns to the numbers that I described earlier. So, after all of this, I bet you're curious how much you could have made if you invested in the Medallion Fund. Well, unfortunately for you, investing was only available for accredited investors who are related to an employee in the business. Nonetheless, we can pretend that was you. If you invested $1 in the Medallion Fund in 1988, you would have $90,129 in 2022, a casual gain of 9,012,800%. This ending return is 567 times greater than the return that you would have experienced with Berkshire Hathaway, and over 5,800 times greater than the return produced by the S&P 500. I don't know if there are any adjectives left to describe how stupidly inconceivable this performance is. So here's a recap of the returns for each investment if you invested $1 in 1988 and didn't take out any money until 2022. $15.54 for the S&P 500, $158.86 for Berkshire Hathaway, and $90,129 for the Medallion Fund. Quite a crazy discrepancy. At this point, a normal person would probably click off the video. After all, I've given you all that you came for. I explained how Jim Simons' ending return was more than 500 times greater than Warren Buffett's over the same period. So I accomplished this video's goal. Almost. Let me tell you something that makes this entire calculation even more beyond belief. This entire video has been quoting the Medallion Fund's net returns after fees. Oh, but fees are usually only a couple percent. It surely doesn't make that much of a difference. Well, for a usual fund, you'd probably be correct. Most market funds operate using a 1 in 10 fee structure. That means they charge 1% on total assets under management and 10% on all profits that the firm produced. So if a fund had $1 billion under management and they produced a 20% profit, the fund managers would receive $12 million from the 1% AUM and a further $20 million from the 10% of profits. In actuality, this would mean that the fund had realized net gain of 17%, not the original 20%, which isn't too large of a difference. Subsequently, this common 1 in 10 fee structure isn't too detrimental for investors, but the Medallion Fund was no common investment vehicle, and therefore had a far from average fee structure. Jim Simons employed a 5 and 44 fee structure, which is extremely high. That means almost half of the fund's gains went to management, not the actual investors. Using the same $1 billion fund example as earlier, the realized gain considering this fee structure would only be 5.2%, which is much different from the original 20%. I'm saying this to show that all of the numbers that I've used for the Medallion Fund up to this point are the post-fee numbers. This means that in reality, the returns of the Medallion Fund were much greater. For the rest of the video, I'm going to be re-explaining the performance of the Medallion Fund using returns that are unadjusted for management fees. Just pure investment growth. Let's start with 1989. During this year, investors in the Medallion Fund experienced a net loss of 3.2%, but this number was highly influenced by management costs. The actual fund had a gross return of 1%. Still very minimal, but I think it's an important distinction because with this in mind, it's fair to say that out of its 34 years of existence, the Medallion Fund never had a losing year in the stock market. To show how unbelievable this is, the S&P 500's longest yearly winning streak in history happened in 1982 and lasted for just 8 years. The odds of the S&P 500 having a 34-year winning streak like the Medallion Fund did stands at a measly 0.005%. All of this to say that the Medallion Fund's consistency is even more fantastic than before. The thing that's even more fantastic though is the Medallion Fund's gross annual returns. Irony aside, the returns before subtracting management fees are truly disgusting. After 1990, the lowest performing year for the fund was in 1997, with a positive return of 31.5%. That return is 1.34 standard deviations away from the average return of the S&P 500. This means that the Medallion Fund's worst performing year ever would place it in the top 91st percentile of yearly returns in the S&P 500. Even more incredible, only from 2005 to 2008, the Medallion Fund outperformed the entire S&P 500 over the last 34 years by a factor of more than 23%. Overall, the Medallion Fund's compound annual growth rate over the predetermined 34-year period stood at a world-bending 68%. This means that if you invested just a single dollar in the Medallion Fund in 1988, your ending value without any management fees and without selling any of your shares would be $45,070,952, a gain of 4.5 billion%. Of course, this number is completely unreasonable for a variety of reasons. First off, the heavy fee structure was designed to limit the growth of the fund in the first place. Additionally, it's still impossible that any investor wouldn't take gains after seeing the results the Medallion experienced. In fact, the Medallion Fund's assets under management have stayed relatively stable at $10 billion for the past 15 years. This indicates that investors have been consistently siphoning off profits in the multiple billions for decades. To prove this, we can look at Jim Simon's personal gains from the Medallion Fund. From 2005 to 2008, Simons made between $1 and $2 billion each year from his investments in the fund. In 2020, during the height of the COVID pandemic, Simons left that year being $2.6 billion richer. He was one of the highest paid hedge fund managers for multiple years, and his personal wealth exceeded $31 billion in 2024 when he passed away. Amazingly, it's estimated that Simon's Medallion Fund has made over $100 billion in realized profits for investors throughout the years. And considering that the number of investors in the fund has stayed consistent between 200 and 300 people, it's highly likely that Jim Simons is single-handedly responsible for creating multiple billionaires throughout the 34-year time span. So, you probably made a bad decision in that summer of 1990. Had you given your extra money to the quiet math professor in Central Park, you'd most certainly be a multi-millionaire by now. Good going.